In today's video, I'm going to teach you how to enable and use margin investing on Robinhood. Whether you're looking to expand your investing strategy or simply curious about how margin works, by the end of this video, you'll understand how to get started with margin investing, what it means for your buying power, and the key details you need to stay safe and informed. First, let's begin at the very start. Head over to robinhood.com and log into your account as you normally would. Once you're inside your dashboard, navigate to the top right corner and click on the Account button. In the menu that appears, select Investing. Here, you'll see an option to enable margin investing. Go ahead and click to enable it. Now that margin investing is enabled, your dashboard will look a little different. Specifically, you'll notice that your buying power is displayed. Buying power is the total amount of money available for you to trade. With margin enabled, this amount includes not just your own cash, but also the funds you're able to borrow from Robinhood. So what does this actually mean? When you have margin enabled, you can borrow money from Robinhood to purchase more stocks than your cash balance would typically allow. This gives you greater purchasing power, which can potentially amplify your investment returns. But it's very important to understand the responsibilities and risks that come with this extra buying power. The money you borrow isn't free. Interest on any borrowed funds begins accruing daily, and Robinhood charges you for this interest on a monthly basis. It's a good idea to keep an eye on the interest rate and to understand exactly how much borrowing will cost you over time. There are also risks unique to margin investing. Losses can exceed your original cash investment because you're trading with borrowed money. If the value of your investments drops too low, Robinhood may place what's known as a margin call, requiring you to deposit more cash or securities. If you're not able to meet that margin call in time, Robinhood has the right to automatically sell some of your investments to cover the borrowed amount, even if it's at a loss. To avoid getting caught off guard by a margin call, you'll need to maintain at least 25 to 30% of your borrowed funds as equity in your account. This requirement means you should always be aware of your account balance relative to what you've borrowed. Above all, remember to borrow only what you know you can repay. Margin investing can magnify both your gains and your losses. It's a powerful tool, but with that power comes real financial risk. So, to recap, enabling margin turns on the ability to borrow through Robinhood, boosting your buying power, but also introducing new responsibilities. Always monitor your investments closely, stay informed on your borrowing costs, and never risk more than you're prepared to repay. Thanks for watching. If you found this guide helpful, take a moment to review your margin options and stay responsible with your investing decisions.